So the entire risk dynamic of capital markets has changed in the recent years, both equity and fixed income, in that it's not just a higher level of risk that we're seeing, which we're certainly seeing that, but it's also the elevated severity and frequency of volatility shocks that we're seeing in both markets. It's a very real risk in that when you think about portfolio construction, you have equity allocations, you have fixed income allocations, and both of those have more tail risk associated with them, and they're not as diversifying as they were in the past because of that higher stock-bond correlation. All of a sudden, you have much more downside exposure in your portfolio than you had just a few years ago. A lot of the change in the dynamic of market risk, both in equity and fixed income, is due to what I call microstructure issues. One of the biggest at play is the institutional shift from active to passive investing over the last 2 decades. So 20 years ago, about 5% of total institutional assets passively managed, meaning 95% active. A lot of analysts worrying about balance sheets and financial statements and valuation multiples. Today, that number has been cut in half, so about 50-50 active versus passive. A lot fewer analysts worrying about these kinds of financial implications. What does that mean? That means that price discovery is less about institutional participation and more about retail participation. With retail participation, you get some animal spirits, you get some emotion. As a result of that, that has manifest in deeper drawdowns in equity and fixed income, which is measured by that volatility shock. So the severity has increased, the frequency has increased markedly. A lot of this has to do with that institutional shift from passive to active, or really from active to passive.